Hey everyone, welcome to Freight Beat, a podcast from the Transportation Intermediaries Association. I'm Patrick, and 4 times a year for every quarter, TIA publishes the 3PL Market Report, which is built from what TI member companies report about their own shipments, their own revenue, and their own margins. The newest issue just came out and it covers the second quarter of 2026. And there's a lot of interesting findings. Shipments up, revenue up sharply, invoice amounts up sharply, and one number still moving the other way. My guest is Avery Vise. He's the Vice President of Trucking at FTR Transportation Intelligence and the person behind the economic analysis in the report. Avery's been covering transportation for close to 40 years. He started at McGraw-Hill covering commercial aviation, moved to trucking in 1998, spent a decade as chief editor of Commercial Carrier Journal, ran trucking research at Randall Riley, and joined FTR in 2017. He writes FTR's monthly trucking update and hosts their weekly trucking market update podcast. Avery, welcome to Freight Beat.
Thanks, Patrick. Good to be with you.
So before we get near the actual findings of the report, can you kind of set the scene for us? Set the table for anyone who's never opened this report. What is the 3PL market report? Where does the data come from? I mean, I touched on it briefly in the intro. What does it show a broker that they can't get anywhere else?
Sure. So the main thing that the report does is provide data that is supplied anonymously by member companies, and it is very direct data that is of importance to brokers. There's a lot of data out there on carrier rates, right? There's a lot of spot market data which we follow ourselves, and there's contract market data, and all of that is really basically on how much the carrier is getting paid, or maybe how much the shipper is paying. But there isn't really any other source that I'm aware of that provides the data like this, which is the things that really drive profitability and unfortunately survival sometimes for brokers. The things that are most important, the metrics that are most important, and it's the data is collected directly from members. As I said, anonymized. We don't see any of the raw data. We just see the results that TIA provides us, and allows us to analyze those very aggregated results that you just kind of in very, very broad terms summarized. So it's something that you're like, okay, what is the source of this data? Well, no, it's actual brokers in the market providing actual data that they're generating through the course of their business.
And is it a nice, variety of brokers, size, location? Is it well represented across that?
Yeah, I mean, again, we don't know, we don't see who's actually submitting, but we're definitely advised by TIA that it is a good participation among various sizes. The report breaks it down to basically under 16 million in revenue, between 16 and 100 million, and over 100 million. And those are companies that have different needs. They have different capabilities, obviously different workforces in terms of just the number of people that work for them, different technologies and things like that. So it's important to not only provide the broad numbers, but also, a small broker, if you look at the broad numbers, they might not really be that relevant. It's important to see those numbers, but what's perhaps more important is to see how those numbers apply to your peers. And pretty much throughout the report, we have that data. So you can look at the broad number, or you can look at the detailed information by firm size. It's really put together well. I can say that it's put together well because that's not being immodest. We are relatively new to doing this. TIA has done it either internally or with partners for many years. We had a stint ourselves working on this a few years ago, and have come back, unfortunately, due to the far too young passing of Donald Broughton, who was doing it before, someone I knew for, I guess, 25 years. But we're excited to at least be able to provide that information to TIA members. TIA members are very important to us because they're major clients of FTR, and so it's a good symbiotic relationship really between us and TIA.
Amazing. Thank you. And thanks for calling out Donald. He was a legend in the industry, and we were lucky to work with him for so long. I should also just mention real quick, if you are a TIA member, this market report is free with your membership. If you're not a member, you can still purchase it and have it. And of course, I would be remiss if I didn't say, if you're interested in joining TIA, of course, let me know, reach out to us, and we'll help you with that. But as far as if somebody reads this report and their business looks nothing like the averages that are represented there, how should they be reading it?
Sure. It's not intended to be a blueprint for, oh, you're in trouble if you don't match up, with the average. First of all, you know, you don't want to be average anyway, right? That's not necessarily a goal. But also, I think the main takeaway that people should have is, am I moving directionally in a similar manner? Am I, obviously if you're outperforming the average, then, there's no worry at all, right? But if your gross margin percentage is actually going up instead of going down, hey, great. But even if you are, moving, weaker fashion, I think as long as you're not orders of magnitude off, let's take an example. Obviously, this month is not probably, or this quarter, I should say, is not really the best example because some of these numbers are unusually large and positive. But, let's just take let's say revenues went up 15% and yours went up 12% or 10%. That's not an issue. Obviously, if they went up even more than that, great. But, what you don't want to have happen is you don't want to be moving in the opposite direction. And again, even one quarter is not such a big deal. I mean, this is a report that is intended to be used, over time. Now, in putting it together, we're cognizant of those trends, and obviously in the report itself, for both shipments, as well as the financial metrics of invoice amount per shipment and gross margin percentage. The report shows 8 quarters worth of progression. So, you can kind of see like, okay, well, this number is unusually large and I don't match it, but guess what? It's unusually large relative to recent history too. So there, I wish it were an exact science to be able to say, okay, as long as you're within, these number of percentage points of the total, you're great. Obviously, if you're above them, you're great. But it's really more of a qualitative and subjective view. I mean, running any business, and I think running a brokerage in particular, because you're worried so much about what's going on with shippers and what's going on with carriers, you have to draw from multiple sources. And TIA, the 3PL market report is obviously a very important one, but it's not the only one. So if you look at other sources of information too and see how those square, they're not going to square exactly because the TIA market report is providing some things that are completely unique, as I said earlier. But certainly there are other elements of it when we're talking about things like margin, because margin obviously involves revenues, it involves the expense side, and it also involves what you're paying to carriers, which I guess is the expense side.
Okay, great. So let's get into these interesting numbers that you're kind of seeing. These larger numbers kind of moving in a mostly positive direction. At the highest level, what does the second quarter tell you? What's important for us to know?
Sure. I think the second quarter told us kind of what we expected based on the other information we had. So, one thing that has happened is there has been a supply side, for the most part, recovery in the trucking sector, which is obviously the biggest driver, whether we're talking truckload or LTL. And even intermodal tends to follow trucking in a lot of ways. So, we knew that rates had gone up very quickly. So the margin compression was not a surprise. And I think it's actually even more encouraging to brokers to see that the margin compression was smaller than it was, I think, in Q1 for the most part. I don't have the report in front of me handy, but it's it is progressing more or less how I expected to be. I expected there to be greater volume. I expected there to be definitely improving invoice amounts. May not have peaked out on that, because what typically happens is the carrier rates tend to go up before shippers, jump on board. They have to see it happening first. They have to respond to it. They obviously have their own relationships, often directly with carriers, and they will often try that first. And so there does tend to be sometimes a progression where carrier rates outpace shipper invoices for a period of time. And that's really what we saw. So I think what we saw is a very strong quarter, but also one that really progressed according to for pretty much what we would have expected to see. After we put together the Q1 report, looking at, which we unfortunately did late because of Donald's passing, but seeing the numbers that came out, there weren't really very many surprises in the report. Just a couple of things maybe here and there, but I think the big takeaway is that it has shifted quite significantly toward brokers, and we would generally expect to see that improving even further, because if you look at some of the other data metrics, for example, carrier rates, at least in the spot market, seem to have stabilized. Now that will sort of bleed over into continued contract rate growth, and that should add to the invoice amounts per shipment and some of the other strengths. So there should be more runway here. It's not like we're looking at Q2 of 2026 being the peak of this market from the perspective of brokers.
So things are moving in kind of the direction you expected. You think that that margin kind of issue is going to continue to improve. Is there a typical kind of recovery sequence, or how that tends to work, or is it just kind of a case by case basis?
Well, in very broad terms, what you generally will see is volume recovering. That puts some pressure on carrier rates. That tends to put upward pressure on shipper invoices. And so what ends up often happening, and this has happened in certainly in various cycles over the last decade at least. If you look at 2017 and 18, and you look at late 2020 and 2021, is there is a sort of a catching up phenomenon where early on, everybody talks about how wonderful the market is, and brokers are like, well, yeah, kind of. I mean, because they're seeing that margin compression, they're dealing with carrier rate issues, at least as much, if not, more so than they're enjoying the recovery in the shipper pricing. But that does tend to stabilize. This market is looking like it might be a little bit like the 2017-2018 market, with a possible upside to it, which is that one thing that happened in that one is not only did sort of capacity grow to meet the demand, which loosened some of the pressure, unfortunately for brokers, but also there was sort of a softening of the metrics that generate freight. Manufacturing, for example, kind of peaked out in 2018 and was softening in 2019. In this case, we're not actually seeing that, and if anything else, we're seeing the reverse. So certainly is some potential there. I think that that's good to have more runway, I guess, to sort of mix metaphors. Although actually, we do we do include some air cargo information, grouped into the miscellaneous category. But it's there's definitely some plus side that we're seeing. There's also some concerns, and we can talk about it later. But there's some markets that are certainly not doing as well as the industrial sector, and I don't want to overstate the industrial sector. It is recovering and it is growing, but it is still sort of not kind of where it was before the pandemic. But again, that's good news and bad news. Bad news is, well, we're not back to where we were before the pandemic. Good news is there is certainly the chance we will get there. Whereas if we'd been running at a peak level, there'd be some real worries that it's not going to get much better than this.
Okay, great. So as far as taking this information, I mean, a lot of it sounds promising. Sounds like a lot is TBD. But what are some specific takeaways, both good and bad, that brokers can take from this report this quarter? I think it's interesting to look at the numbers, but as far as like using that information to better your business, what does that look like?
Sure. Well, I mean, I think one issue is that growth, which I said is what we expected, but I have to be honest, it was definitely stronger. It was directionally what we expected, but it was stronger. And I think that the main thing that brokers need to do is not get too overconfident. You had a very strong Q2, you had a much improved Q1. And while I do think that there is some acceleration in certain areas that could happen, there's a lot of risk too. We have energy costs very high. Diesel prices just hit their highest level since the beginning, highest level of this year, and really not all that far behind a record level. We now have trade coming back into the forefront with a potential trade war with Canada. So there are some things that can undercut this. So I think the biggest takeaway from the totality of the report is that discipline. I think that brokers had to adopt over the last few years, just in some cases for survival, in other cases to maintain some level of profitability. Those should not go out the window. Those really should stay in place as much as possible. Obviously, there's going to be some areas where you need to devote some more resources to sales or to carrier relations or things like that than you had to before. In the case of sales, it was more of a you're not going to get the sale, so why bother? Sort of an environment where that's obviously not the case now. So I think not losing that sort of discipline that does seem to have been in place recently based on anecdotal evidence, as well as obviously some more empirical, like an easing of the labor force for brokers since the beginning of 2023. So maintain that discipline. Try to use technology as much as possible to increase productivity, and look at how your resources are allocated. I think one of the things that really happened is a lot of if you go back to 2021, you had a very sort of strong sort of carrier recruiting or carrier relation focus, because that was the problem, right? Capacity was the real problem. And then over the last 2 to 3 years, it was sort of like, well, now we need to we don't have any really worries about that. Our concern is making sure we get enough freight. So you had a shift back to sort of a generating sales focus. Now we're sort of in a middle ground where you kind of have both, and you have to be flexible, because there's definitely some arguments to be made that this could go either way. You could end up with even tighter capacity, which would tend to argue in favor of brokers devoting more and more resources to carrier development. Or you could have that level off, and you could have the economy sort of soften, and then obviously your focus needs to be more on sales. So I wouldn't say that we made that point directly, but I think it is implied to some degree, especially in the macroeconomic discussion we had, where I think we really pointed out that there is a lot of nuance here. As in Q1, we spent a lot of focus in that report talking about, yes, the consumer sector is strong, but there's some elements of that are clearly not strong, and you need to be aware of that. This time, we really focused a little bit more on the overall economic picture for the second quarter, and that one was a little muddled, and a lot of it also depends on where are you as a broker in terms of your book of business. Are you more consumer focused? Are you more industrial focus, or construction focus? I hope if you're construction focused, you're involved in data centers, because otherwise you're probably not doing all that great.
Interesting. Okay, so let's just continue down that thread. So aside from your report on the information from TIA members, there's a read on the broader economy. Do you want to talk more about the points from the section that you would most want, our members or just brokers in general to kind of sit with and think about?
Sure. So, one of the goals that we have in how we write about the economy is for people to understand that the numbers they're seeing are not necessarily as good or bad as what they're seeing because of what the makeup of those numbers are at a more granular level, or a big focus in the first quarter report was on inflation both for consumers and for businesses. And we didn't spend as much time of that in the Q2 report, largely because we don't want each report to be that duplicate of the previous one. But that is one element that is important to consider, is that inflation has not gone away, and even if maybe we end up in a more stable fuel environment, especially on the industrial side, tariffs and supply chain disruptions have really generated a lot of price increases, and not even just because of tariffs. Things that are high tech, for example, just simply the demand level is so great that is driving up prices. So, that's one of the takeaways. The other is that when you hear about economic data, for example, the second quarter, the increase was 1.5% in GDP annualized. That was down from 2.1% in the first quarter. We actually got just this week updated numbers, and they confirmed that 1.5%. And you might think, okay, well, the economy is slowing. Well, not really. One of the big issues there is that gross domestic product treats imports as a negative. Imports were strong in the second quarter. Well, guess what? That's good for freight, right? I mean, stronger imports means more freight. Now, long term, sure. If you want to talk about years or really maybe even decades, we would certainly like to see more activity domestically. But in reality, it's kind of a false economy to say, okay, well, we're going to count imports as a negative. And it's certainly false from a freight standpoint. And that was one of the big focuses in this quarter's report, was comparing how the data looks from a freight standpoint versus how the general economic data looks. And those two are pretty different if you read the report. Even more so, and we didn't get into this, this is something we focus on at FTR, is the difference between that freight economy, if you will, and what freight levels actually are. And that's really driven more by the mix of those commodities. There's a lot of digital commodities that go into what's called the goods, sector, software. The comment I make a lot is, one of the big drivers of consumption on goods even is digital downloads. What I suspect is probably coming from console gaming, Call of Duty and Grand Theft Auto and things like that. So
Interesting. So if someone is reading this, or this is their first time checking something like this out, and they're trying to contextualize what this quarter Q2 looks like in comparison to things in the past, I think someone like you is able to call up 2017, 2018. This is reminding me of that. But for people that don't have that kind of, I guess, encyclopedic knowledge
Sure.
of the economy, how can they take this information and contextualize it? And I mean, I think what you're saying is be cautious. Cautious optimism is key here. But do you have any other kind of recommendations for how folks can take this information and contextualize it with trends that happened in the past versus now?
I think, well, first of all, that's part of what we try to do in the report, right? I mean, one of the reasons that TIA is not putting this out by itself is they wanted to have someone who can, look at the data and sort of put it into that longer term context. Not to say that TIA's staff could not do that, but they have other things to do. So, so that's one part of that is, where where relevant, especially when we're looking, for example, over that the 8 quarter look, we often will talk about even things that happened before that. But I think the bigger point is where we kind of started, which is, you know, we're not going to be able to put the entire history of freight transportation into context. So really, it comes back to the numbers and goes back to your faith in the fact that the data is being supplied by your peers. It's not being manipulated. These are these are actual numbers being provided by brokers, and not being sort of, if you look at government data, for example, government data sometimes is very hard to understand, for a lot of reasons, but one is just how it came about. There's a lot of manipulation, there's a lot of assumptions, there's a lot of things that go into that. And this is much more direct, much more meaningful. So I go back to the point about, sort of benchmarking. Am I, every time I pick up a 3PL market report, how am I performing compared to my peers? And again, you don't have to be right on the money. You don't necessarily even have to be that close, but are you moving directionally? And then obviously the question is, okay, so we're not. Well, what do we do about that? Maybe we have put too much focus on generating volume, and we've given up, too much pricing to get there. Now, unfortunately, sometimes that's a competitive thing, and your options are limited. If you're a smaller broker, a lot of times you don't have the ability to offer the same tools that some of the really large brokers offer, and that's going to limit your ability to get as much pricing. Now, the good news is that technology, I've been to the Capital Ideas conference many times. There's so much technology out there that is scalable to very small brokers. And that's something that I think that is another takeaway here, which is that you can look at what's available in the market. How can I compete, on price? I need to be able to offer better services, more services. How can I do that cost effectively without obviously going out and hiring a bunch of people, which I can't afford to do? So I think it's a strategic tool as well, because it's not even just how other small operations are doing, but how can I be aspirational? If I'm a small broker, what's going on with the medium sized, and how can I be like a medium sized broker, even though I'm not? What are the things that distinguish them? And it's often their capabilities. And then, the same thing if I'm a medium size, what do the larger operations have that I don't, and how can I best replicate that in the ways that are most important? So I know it's kind of a broad answer to your question. It's there's so many different, obviously brokers are in so many different areas, they have so many different focuses. Kind of hard for me to say how I could take the report and use it in that very direct sense. But I think in the broad terms of making sure that I'm moving directionally and not by an order of magnitude weaker than my peers, I think is the biggest thing.
Great. Okay, so as you sit here waiting on the third quarter data, what are the things that you'll be looking for? What do you I mean, you talked a little bit about what you see kind of in the future, but can you read the tea
Sure.
leaves for us a little bit more?
I think one of the big things that I'll be looking for is the margin issue, which you brought up earlier, is like still moving in the wrong direction. And yes, technically it is. I mean, you want a higher gross margin percentage than a lower one, but we have seen in the data sequential improvement over that recently. So I would be looking to see, does that turn positive? In Q3. Now, it already was positive in a couple of areas. One being, some of the breakdown by sizes, and unfortunately I don't have the report in front of me, so I can't tell you what they were. But there were a few limited situations where there was actual, sequential improvement. There was an LTL. LTL saw improvement there as well. LTL is a more complicated area than truckload in a lot of ways, and so that's not too surprising. So what I would be looking for in Q3 is to see further margin growth and ideally a positive move in margin percentage. Ideally, even more invoice per shipment. And, volume, this is not a seasonally adjusted data set. So, the only quarter that you really know is going to be weak is Q1. Everything else can be a little bit more volatile. And it depends on things like, 2025 is a good example where you had so much distortion in the import environment that it bled over, into other areas. So at least not taking a step back in volume it would be something I would be looking for. And conversely, obviously, if a lot of things turn negative, as you pointed out at the beginning, there are very few minus signs in this report, except when we're talking about gross margin. So, I think ideally like to continue to see plus signs. I think probably it would be best not to see some of the increases be as large as they were, because that could imply some overheating. I think that would be ideal to kind of see some moderation. Now, if I were a broker, I probably would disagree with that. But I think looking at it more, systematically and strategically, having things be solid over a period of time is preferable to them being, extraordinarily hot and then not being hot at all.
I guess I have two more questions, and then I'll make sure to sign up there. I could go on forever, and I'm sure you could as well. But I'm curious if you have any thoughts about. I mean, constantly the thing on our mind is the legal landscape, the nuclear verdicts. See it, the rulings that have come down. Have you seen any immediate impact from that? Do you see that changing things further? What are your thoughts on that? Do you have any, like a hot take on or anything like that?
So, let's talk about the Montgomery Supreme Court decision, which is the main thing you're talking about. There are a few other verdicts out there. I'm not going to get into details there, but you know, it, as much as it's been discussed, we have to remember that this is still pretty new stuff, right? It's only barely 2 months old at this point that the Supreme Court actually came out with its Montgomery versus Caribe Transport decision. So, isn't a lot of time for there to have been a response. And it was going on in a backdrop where there was already a lot of federal enforcement over foreign drivers. So a lot of stuff gets muddled. And if you look at a lot of the data, beyond the TIA report in terms of, spot market metrics and things like that, there was a lot of disruptions going on. There was weather disruptions, there was fuel disruption, and then in a broader backdrop is this pressure on foreign drivers, which seemed to have really, bumped up the effect of international road check back in May, which I think a lot of people, are very familiar with. That happened to be about the same time as the Supreme Court decision. But I think the Supreme Court decision is more of a, medium term and certainly longer term issue, because part of the problem is that the Supreme Court didn't say what to do about it. Right. One of the big frustrations about the Supreme Court decision is they said, okay, brokers, you are liable to be sued for negligent selection. They didn't say what you can do not to lose that case. You know, Justice Kavanaugh sort of made a stab at it. To be honest, what he did was so superficial. I mean, you welcome the attempt, but it didn't really provide anything all that useful. So, you know, on LinkedIn, from basically the day of the decision really up to now, it's like it feels like every discussion is in the context of Montgomery. But let's back up for a second and say, okay, in a broader sense, yes, it's just going to produce more stress, right? It's going to produce more pressure on those, especially probably smaller operations that maybe have not invested in the vetting tools that they're going to need in order to weather this. So it's one more element of tighter pressure on the carrier base, and by the transitive property by brokers as well, And obviously brokers are even more on the hook. And it is disrupting it even in a broader sense because now asset based carriers are out there saying, hey, we control everything at our company and we have safe metrics, so you should use us instead of brokers. So there's a lot going on. There's going to be some amount of shakeout to this, and it's really hard to predict where all this is going, except that brokers need to, up their game more than they were doing before the Supreme Court decision in terms of making sure they're comfortable with the carriers that they're retaining.
Excellent. Okay. So I think my last question would be, um, aside from what you've talked about, if somebody is perhaps like a more reactive kind of broker, they're trying to stay afloat. Maybe they're a little bit smaller, maybe they're newer to this, but they're trying to integrate this kind of information and become more knowledgeable on the economics of freight, but also just the general economy. Aside from reading this, are there other things that they can do to kind of, because I think in order to be a good business right now, you really have to know what's going on, what has happened in the past, and what's coming in the future. How can you educate yourself best, so you're best positioned to scale or have more success?
Well, you know, at a very big risk of being self-promotional here. I mean, one of the things that we do is we publish a monthly report on not only the trucking freight environment, but the overall freight environment. We have reports on rail, we have reports on intermodal. We actually have a report that is aimed specifically at shippers, and of course, we're not the only one out there doing it. But I think the downside, if you can call it that, of the 3PL market report is that it is only quarterly, right? It's extraordinarily important information, but you can't just say, okay, well, we made all our decisions, we're going to wait a quarter and then we'll make more. So source, we're a source out there. Almost everybody that is transactional in the market, which we're not at FTR. We're independent of anybody who's a market participant. But those who are market participants often are generating, ongoing metrics. That could be a TMS, right? If you're using one of the transportation management systems out there, which I presume almost everyone is, one of the side benefits of that is you're almost certainly getting access to some sort of benchmarking information there. What what it may be spotty, may not be quite as systematic as what we're doing in the TIA 3PL market report, but it's useful. And I think the main thing is to just think, right? Is like, does this make sense? Are all these data sources I'm reading squaring with each other? Because frankly, they should, right? One of the problems with data, and this is something that we I wouldn't say pride ourselves on, but it's probably a benefit for us, is that if you get too focused on high frequency information, things become very noisy. And so we do write about some developments on a weekly basis, but primarily we're focused on monthly and quarterly information, and I think that it's probably works best. I mean, because if you're getting hourly information or weekly information, even in a lot of cases, you may be just misreading signals. Now, if you're a broker and you're operational, it's definitely an opportunity perhaps to seize on something that's going on in the market very specifically, but that's going to be probably much more of a very granular, like, okay, this type of freight is suddenly very hot, but it might not be hot 2 weeks from now. So there's this tension between being strategic and being tactical. At FTR, we're much more focused on being sort of strategic, because we don't really have that sort of like hourly update, if you will.
Great. Okay. So, Avery, this has been awesome. Where do you have any parting shots, or also where should people go to follow you, and your work at FTR?
Sure. I think I've said way more probably I do tend to ramble. I think the best thing to do to get to us is just to go to our website, which is ftrintel.com. That's ftrintel.com. And from there, you can see a lot of resources, a lot of actual complementary resources, in fact. We do publish in conjunction with one of the truck stop suppliers, truckstop.com, rundown on sort of the spot market in the latest week. I also have a podcast that you mentioned earlier that typically is uploaded on Tuesday afternoon. A link to that is there, and a number of other resources that we provide to everyone, as well as obviously our subscription based stuff, where we're really providing, frankly, our most valuable information, of course. But anyway, ftrintel.com. I'm on LinkedIn. Also, you can search for Avery Vise on LinkedIn. And those are really the main things.
Great. And as a writer, this might be a fun little challenge, but just to keep it short and sweet, if this was a chapter in a book this quarter, what would you name this chapter?
Oh, I would call this Happy Days Are Here Again. I think is probably what I would call it.
Happy days are here again, yet stay cautious.
Yeah, stay cautious. That's a long chapter title, but yeah, fair enough. Yeah.
Excellent. So, okay, everything we covered here today comes out of the TIA's 3PL market report for the second quarter of 2026. If you're a TIA member, as I said before, that report is already yours. It's free. You can visit our website. I'll have the links in the descriptions here. If you're not, you can purchase it at the link in the description, tianet.org/market report. You can also learn more about what our membership will give you. FreightBeat is a podcast from the Transportation Intermediaries Association. I've been Patrick, and as always, thank you so much for tuning in.